behalf of EY, I would like to welcome our audience to the next edition of our on-demand audio series on the impact of the pandemic on financial services. In this edition, we will look at the challenges and opportunities facing the wealth and asset management sector. To do this, I have an outstanding group of EY partners joining me again. My name is Brian May, the Accounts Managing Partner for EY's Financial Services Organization. We have Jun Lee and Natalie Diekjaros, our co-sector leaders for Wealth and Asset Management, and Nalika Nanayakera, our consulting leader for the sector, to share their insights today. And with that, I think we should jump right in. COVID-19, coupled with economic uncertainty and financial market volatility, are clearly impacting the wealth and asset management industry, and maybe more importantly, the investor community at large. Natalie, how are you seeing this unfold? And maybe what are some of the key considerations for those charged with governance for the investment managers in the sector?
Thanks, Brian, and thank you all who are listening. I hope everyone is healthy and safe. I'll start by saying that while these are clearly very challenging times affecting all sectors and geographies, the wealth and asset management sector has really held its own despite the many challenges it has been facing. That being said, those who have been charged with governance have many things to focus on today in order to get through the short term while still needing to be thinking strategically for the long term. We'll focus on a few specific considerations, but given the amount of change that has happened over the past few weeks in terms of how firms are operating, there is huge value in stepping back and reviewing the overall enterprise risk management framework as a result of recent changes. So let's start with liquidity, which has been one of the areas of particular focus in this market. During these times, when there is a question about liquidity of certain markets and products, such as real estate, infrastructure, among others, we are seeing more frequent liquidity analyses being done, and that's critical. This is particularly true for funds that allow redemptions and have had significant redemptions. And what needs to be considered is the weighting of illiquid investments after those redemptions are paid and the impact on future performance and portfolio allocation. Consideration also needs to be given to the valuation of these illiquid assets, particularly in volatile markets. These are times when difficult decisions need to be made about whether to enact certain provisions within the legal agreements as applicable. These may include moving illiquid investments into side pockets or enacting gate provisions. Those are all considerations and decisions that those charged with governance should be part of, with an eye towards what is within the fiduciary obligations of the manager and ultimately fair to investors. As it relates to credit risk, similar considerations. This is a time when things like stress testing are critical. This would range from activities such as reviewing corporate and government bond portfolios related to default risk and the impact to the portfolio, to, on the other hand, tracking financial covenants to be prepared for margin calls as needed. Managing collateral is critical at this time, as we've seen many firms needing to understand their collateral landscape quickly in order to move collateral between brokers. And again, having a strong governance structure around these processes is really critical. So let's move on to the business tax considerations. And for that, I'll pass it to Jun to cover.
Thanks, Natalie. I hope everyone's doing well and safe. Just to add on to your observation on credit, the credit markets have experienced a lot of price movements, and many investment managers are looking at the distressed debt markets as potential buying opportunities. Whether it's buying third-party debt directly or acquiring pre-existing third-party debt in an SPV at a discount to par, it is important to consider the tax implications of phantom income such as OID, market discount, and COD income, as well as withholding tax exposures on interest. The tax planning and structuring of these transactions need to be flexible and adaptable to a changing commercial and regulatory landscape, and at the same time, well understood by the investors and advisors. Now, let me move on to highlight a few CARES Act business tax relief for investment managers, many of which presents potential cash tax benefit or refund opportunities. Fund structures with U.S. corporate entities. The CARES Act allows the taxpayers to elect 5-year NOL carryback incur within a prescribed period. It also temporarily suspends the 80% limitation on the use of NOLs incurred in taxable years starting after December 31st, 2018. The refunds from the NOL carrybacks are intended to provide taxpayer with an immediate liquidity benefit. There are other relevant provisions that should be carefully reviewed for its applicability, such as accelerated AMT refund allowances, increase the allowance of business interest deductions, and retroactively immediate recovery of qualified improvement property costs rather than over a 39-year recovery period. Quickly switching over to employment tax area, the CARES Act provides an employee retention credit for employers impacted by COVID-19, as well as payment deferral for remaining 2020 employer payroll tax. Employers will need to consider whether they intend to avail themselves of SBA loans made available through the Paycheck Protection Program under the CARES Act. For employers who receive SBA loans that were forgiven under the CARES Act are not eligible to utilize the payroll tax deferral and retention credits. There are other non-tax considerations investment manager need to consider here, such as reputational risk. Natalie, let me turn it over to you to provide some observations on those responsible for governance and how one should be thinking about reputational risk.
Thanks, Jen. And I think that's a great point. Reputational risk is just such a critical consideration, and it's impactful for all stakeholders of an organization, including investors, employees, counterparties, et cetera. Particularly during times like these where there are many difficult decisions to be made quickly. Many of these decisions, in retrospect, can impact the brand of a firm. So it is critical that those charged with governance have the brand and the reputation of the firm as top of mind when reviewing and making decisions on behalf of that organization.
That's great insight. Maybe we can turn to Nalika for considerations in the wealth management sector.
Thanks, Brian. So if I take the big picture view, we are coming off a decade-long bull market where passive investments reigned, and some clients actually started to question the value proposition of financial advice and wealth management. The current environment is exactly the type of unexpected, uncertain situations where the value of financial advice is self-evident. On the one hand, your wealth manager or advisor will help you take the emotion out of your investments and keep you focused on your long-term goals. On the other hand, they will help you rebalance your portfolio, given that it's likely out of whack given the equity market volatility, take advantage of tax loss harvesting, and overall optimize your portfolio. That's the good news. But the not so good news is we're operating in a depressed value environment, and AUMs have taken a big hit, and there's more uncertainty to come. We don't know how long value depression will persist. Over the past few years, wealth managers have moved more of their client assets to advisory platforms where wealth manager fees are correlated to assets under management. So we do expect wealth manager revenue to be impacted, at least in the short term. Let me hand it over to John for his perspective.
Thanks, Nalika. Individuals and families are facing so many issues already in responding to COVID-19. With the recent passing of the CARES Act, individuals will need to understand the impact of their personal tax situations. The support needed will be different depending on the individual's facts and circumstances. It could range from understanding the tax impact of withdrawing from employees' 401k account to temporary relief from student loan repayment. For certain segment of the market, Roth IRA conversion planning and estate tax planning will be important in a low-value, low-interest rate environment. In the near term, supporting advisors and customers of the advisors with potential cash tax benefit and refund opportunity and providing liquidity and relief will be critical. Helping customers navigating through the pros and cons on taking SBA loans versus payroll tax relief will create opportunities for the advisors to strengthen their trust and relationship with their customers. The challenge will be the timeliness of the insight, personalization of the individual customer's tax need, and methods of delivery. Back to you, Brian.
Well, overall, it seems the industry has held up reasonably well from a continuity perspective. But what are some of the focus areas that our clients should have now? Nalika?
Yeah, that is true, Brian. Let me talk a little bit about the environment we are in, everybody working from home. And so are the front office personnel making financial decisions that impact the firms and clients. Whether you're a trader, portfolio manager, or financial advisor, this is new to you. The work from home directives are changing the employee's cyber risk profile. There are bad actors out there trying to take advantage of this situation. At the same time, there may be less scrutiny on the compliance and supervision controls that everybody took for granted in the office or the branch. On top of that, you have sensitive phone or video conversations while office voice assistants are listening in the background. So it's critical to ensure that data protection, privacy guidelines, controls for work from home are reviewed, refined, and communicated to everyone working from home. Let me hand it off to Natalie for points around third-party risk management.
Thanks, Nalika, and some great points there that I think would apply here as well. So let me just take a step back. Most of this industry is greatly reliant on third-party vendors, and so managing that risk is important. For now, I would say what we've seen, most vendors have transitioned very well to a work-from-home environment. However, I do think there are a few questions that should be asked, particularly if the pandemic and this way of working continues for the foreseeable future. The first being, given the speed at which firms needed to change the way they work and communicate, are existing controls still operating effectively? And maybe an add-on to that question would be, have there been any overrides in existing controls to accomplish the change and to be able to deliver in a different environment? The second question I would ask is, what is the viability of third-party vendors if this current environment continues? Is the entity a going concern? Have the third-party revenue sources been significantly impacted? And lastly, maybe a question around the global landscape, right? It's changing so quickly. And so firms really need to understand the level of reliance on a global workforce that our third-party vendors have and the risks and contingency plans associated with different geographies depending on the pandemic and the ability of those geographies to migrate to a full work-from-home schedule. And so I think knowing the answers to these questions will really help managers prepare their own contingency plans and be able to react to different issues as they're identified. There are also tax risks to be considered, and for that, I'll pass it back to Jen to talk about.
Thanks, Natalie. One thing that's generally top of mind when we're talking about a global workforce as business being impacted by travel restrictions for the employees, there are general permanent establishment and tax residency thresholds that firms are monitoring from a tax risk perspective. The OECD recently released guidance to encourage local tax administrations to update their guidance to ease the administrative burdens on businesses. At the same time, the volume of constantly evolving global, federal, and state tax policy and legislation can be overwhelming. Firms should consider having a process in place to track the current legislative changes, available relief and incentives that are most relevant to their businesses. This is a great way to get access to relief and liquidity to the business where it's most needed.
Quite a few considerations for sure. As the industry comes out of this health crisis and we look forward, what are some of the operational transformation opportunities that our clients are considering?
That's a really interesting question, Brian. Thank you. A lot of our clients are using this disruption to question the things that they took for granted. Essentially, what are the lessons learned that you want to incorporate into your future operating model? There are a few things that are bubbling up to the top of our client conversations. First, we will see an acceleration of digitization of client engagement processes. Even the clients that were most insistent on face-to-face meetings have adapted very, very quickly to using technology to connect with their advisors. I'm not suggesting that virtual meetings will be the primary way, but there will now be a mix of meeting options or engagement options that clients can choose from for their convenience. This will also have some impact on the physical branch footprint of the wealth management firms in the future. Second, most firms were already investing heavily in middle office and back office process automation, and we expect that to accelerate as well. If I may use a small example, one of our clients lamented that they were still requiring wet signatures to open new accounts in an environment where they were lucky to have anyone wanting to open an account. We've seen firms already prioritize projects to streamline and automate contract and document processes and management tools. But there are a lot of other middle and back office process related to account management, client servicing, reporting, etc., that will also be focus areas for further automation. Lastly, we will see significant investments to improve platform scalability and stability. Wealth and asset managers have seen trading volumes spike 300, 400% on some days. Wealth and asset managers will need to extend the thresholds and scenarios when they plan for platform capacity in the future. I would say those are some of the top transformation opportunities for wealth and asset management firms. Brian, back to you.
Thanks, Nalika. It's very clear that the journey from analog to digital continues and will likely accelerate due to this pandemic. So on behalf of our audience, I want to thank our speakers today for their insights. And for our audience, I encourage you to stay connected to EY.com for future editions of this series and all of our thought leadership. For questions and feedback, please contact your EY relationship partner or any of our speakers today. Thank you and continue to be safe.